All right, we're 12 on the dot. So I'm sure a few more people will start to trickle in here, but figured we can start to make introductions and talk a little bit about format, just so everybody knows what to expect today. So kicking off, I suppose Patrick Swift here from Amplius Wealth Advisors, for those who are familiar. We got 5 of us on the call today. We do have, I think, an hour scheduled. Hopefully we're a little less than that, only just because I think people's attention spans won't last that long, but we've got some really good content to cover. So we'll go through kind of rapid fire on everything. Joining us from the Amplius team is Matt Liebman.
Thanks, Pat.
Aaron Marks.
Good to be here.
And then from Vision Financial Group, a couple of really good friends and trusted professionals. We've got Jacob Ansel.
Nice to meet you.
And
Glad to be here.
Aaron, am I saying your last name right? Aaron Beavis?
Beavis. Yeah, and it's great to be here.
Awesome. So we got a all-star cast here, and just to give a quick rundown for attendees of what to expect on today's call. Again, like I said, we have an hour scheduled. We'll try not to use the full hour, just to again keep it light and refreshing. But the main couple of things we're going to touch on is hopefully some actionable, executable year-end strategies, reducing tax bills, optimizing, etc. Based on the attendees that registered, we've got a good mix of folks who are pre-retiree, working for public companies, W-2 style folks, and we've got also a fair amount of business owners on the call. So some different things for different folks. We'll try to get things that are topical for everybody who's attending. We'll talk a little bit about things to consider around retirement if you're approaching, mistakes to avoid, and then we'll also chat a little bit about the upcoming potential legislative changes on the back of this fun election we just had. So you guys all ready to kick off here?
Ready.
Do it.
Let's go.
I'll stop sharing and we'll just go straight conversation mode. So we'll start off with some low-hanging fruit. So around this time of the year, I'm sure investors, clients of Amplius, clients of Vision Financial Group, people talk about tax loss harvesting every year. It's a pretty basic concept, but I think it's a good one just to kick off on, being that we've got an investment group and a tax group here. So who wants to take the bait on the first one and just explain the concept? What the heck is tax loss harvesting? Why does it matter? Why is it important?
All right, fine. I'll do it. You push me. So the idea is actually quite simple. And I will tell you that many CPAs do not work carefully with their clients or guys like you, who control the investments to do this. And it's a really simple tool. Okay, so the month of December is here. What are we telling our clients? Give us your brokerage statements to date. Let's see what your capital gains are. Okay, let's see your holdings. So oftentimes what we find is there's massive capital gains in a nice healthy account from sales of stocks and bonds, etc. And we could take a quick example where we have 150,000 of client X shows capital gains, and we look through their portfolio and we see that they have, at least 150,000 of stocks or bonds that have built-in losses, right? Unrecognized, not sold. Very simple idea. Sell them, okay? Offset all of your capital gains for the year. Now, if you like those holdings and you believe they'll go back in the future, just wait, the 30, 31 days so that the wash sale rules do not apply, and rebuy them, right? Now, what's the risk there? Okay, in 30 days, the stock could go through the roof. That is the potential. But I think you'll make a lot more money not paying tax, say, for example, on $150,000 of capital gains. At most people's rates, we're talking, just about $50,000 of tax. And whatever you're selling to offset that is probably not going to jump up by 50 grand during that period. So those are the basics for tax loss harvesting. There's a lot of more intricate things that we can get into. And I'm happy to open it up, to Aaron, Pat, Matt, the other Aaron. It's great that we have two Aarons here.
It's confusing for everybody.
We'll refer to Aaron Beavis as Aaron B and then Aaron M.
That's right. That's right. So on that, Jake, a perfect job kind of articulating what it looks like. in terms of the wash sale rule you mentioned, just for the audience too. So that means if you have Apple stock somehow at a loss, which would be virtually impossible with how well Apple stock is done, but let's say you did somehow and you sold that position, you could not buy that stock back, Apple stock in that example, for 30 days, or you'd have a wash sale, you'd have a disallowed loss. Matt Liebman, you want to talk a little bit about how some of the ways we'll try to avoid that to avoid or mitigate the risk that Jake mentioned of being out of the market, missing out on ups and downs within the market for 30 days?
Yeah, I think it depends a little bit on what the actual holdings are. So first of all, to Jake's point, we're talking about 30 days here. So if you really want that tax loss, you can sell whatever it is, wait the 30 days, and most things are not going to go through the roof in 30 days. But to Jake's point, it is a risk and it is possible. So one of the ways we mitigate that is by using ETFs. I imagine most people on the call know what ETFs are, but exchange traded funds, basically a more modern version of the old-fashioned index fund. And so let's use in the example, as Pat said, it's tough to have a loss in Apple, but we'll use that anyway. You have Apple, you have Google, you got JP Morgan. I'm just naming a few random blue chip companies. And they're all sitting at losses for some reason in your portfolio. Maybe you just had really lousy timing, whatever it is, but you still like those stocks for the long term. You can sell out of those, take the loss, and buy some sort of large cap, and we're happy to help people find it, large cap index fund or ETF to largely, it's not a replication, but it's largely will have a generally reasonably similar experience, but different enough, where in a sense, if Apple, Google, JP Morgan, all these stocks have their through the roof moment over the next 30 days, chances are that ETF's going to do just fine also. Now, there are some nuances and complications with that, but in general, that is one way that we look to mitigate. And just on another one is a lot of times if there's a loss, it's in an ETF already, not in an individual stock. And you can swap out of one ETF and buy another as long as they're different enough that I don't want to speak for Jake, but that generally passes muster on the watch sale rule.
It does, Matt, and that's a good point. And I will tell you, most of the wealth management companies that we work with on behalf of our clients do not think of that. And it's really important. And I want to use the Apple as an example, right? So an ETF, and correct me if I'm wrong, I'm certainly no expert, but in the S&P 500, any ETF would carry Apple, Nvidia, Microsoft,
Right.
Those Tesla, right? Those are the holdings there. So if by some miracle you had a loss, say in Tesla, okay, and you're using that to offset your gains from the sale of Apple, okay, people want to still hold Tesla. So the feedback that I get from the wealth management advisors is, oh, just wait the 30 days and then buy it back. But your point is actually better. If you bought an ETF in the S&P 500, am I correct by saying you're holding a large portion of that in Tesla anyway? Is that right?
Yeah, so Tesla would be one of the top 10 holdings, and a lot of the other big holdings probably have some degree of positive correlation with Tesla as well.
And if you wanted to get more direct and more correlated, you go buy an AI, electric vehicle, whatever have you,
Good point.
ETF that has a big exposure to Tesla and other similar companies. So
The beauty of maybe to keep us moving on topics, to wrap it up on the tax loss harvesting point, I think nowadays with the ETF structures and all that's out there these days, there's so many ways you can maintain exposure to markets and where you want to be without violating tax rules. And the other thing too, the beauty of sometimes just taking losses, even if you don't have gains, Aaron, B, and Jake, is you get to carry forward those losses. So if you have a big business sale in the future, you have something that you're really working towards offsetting. If you're not using the losses today, you can in future years. So that's always a big one too.
I agree. I just want to bring up one more point. I know we're on this topic for a little bit, but for the attendees, I think that this is something that's very important. If you do have a large capital gain from the sale of, closely held business, or you bought Apple in the 80s and you really want to do this, I don't know how you guys feel about this, but we oftentimes will recommend a QOF. And, do you guys work with QOFs?
You're talking qualified opportunity zone fund, or?
Exactly.
Yeah.
There are a few that are publicly traded, right? They have the Bell Point and the Parkview. These are publicly traded. qualified opportunity funds, and whatever money you put in there, say you have $150,000 capital gain, you put 150 into a QOF and you hold it for 10 years, you pay no tax on that gain.
Right.
So if you do have stocks that you don't want to sell at a loss for tax harvesting, there are other options available, and we can make that a whole separate webinar here. But I just wanted to throw that idea of the QOF out there. Qualified opportunity funds.
That's a great, I think, segue too, to just some other investment related tax planning topics. Qualified opportunity zone fund. Jay, correct me if I'm wrong. You have a 6-month period. Let's say I sell my business today or sell my Apple stock today on December 10th. I have obviously it would be taxable for this tax year. So maybe timing is a bad example, but I have up to 6 months to invest in that new qualified opportunity zone fund to be able to capture and defer gains.
That's right. But one thing that you said is very important. Even if you put it in after the 6 months, you still get to take that against your sale on the current year.
So,
okay,
very
so it gives you time. It's like doing a 1031 exchange.
Right.
Right.
Same
idea.
Which is an even better segue. So I was open, and I have 2 other things that I was going to get Aaron M and Aaron B's opinions on, but we'll come back to that in a second here. Since you mentioned the 1031 topic, really, I guess Aaron B or Jake, why don't you walk us through just briefly? I think a lot of folks are probably familiar with the 1031 exchange, but give us the quick bullet points on what a 1031 exchange is, because we have an idea to talk about in that capacity as well.
Sure, I could take that. So 1031 exchange is a good way to defer your income, your gain on a sale of real estate. So if you, let's say, had a real estate that you bought for 100 grand, let's forget depreciation, and you sold it for 200, you have a gain of $100,000, and you don't want to pay tax on that $100,000 today. What a lot of people end up doing is they work with a qualified intermediary and their CPA. It's very important to keep your CPA in mind when you do this as well, not just your intermediary, not just your advisors, right? So you want to keep everybody in the loop with regard to this. And so what you end up doing is they basically hold on to that cash, and you go and you have like a 45-day period to identify your next property, and then a little bit more to purchase that property. And so what you're basically doing is you're rolling into the next investment property, and your cost basis in that investment property is your original $100,000 cost basis. So what a lot of people end up doing is doing that exchange all the way until the end, right? And then their estate plan handles the rest.
Right. Right.
Yeah, and if I could just add something to that, Aaron, which is that many people can't identify and close on a project for a new property. They can't identify it in 45 days. They can't close within 180 days. And unknowingly, I brought up the idea of the QOF, but they can also do a qualified opportunity fund, right, to offset any gains, and a self-certifying one if they don't want to go into the public. But yeah, it's a great tool to defer gains down the line. Absolutely.
So just to read that back, I've got an investment property. I'm going to sell it for $1 million. I bought it for 500. So now I've got this $500,000 gain I would otherwise be paying taxes on. But if I can somehow jump through the hoops of buying a new property within 5 days of sale, that $500,000 gain, I get to basically defer into my new purchase. Am I getting that right?
Yes.
Okay. And to your guys' points too, on the qualified opportunity zone fund, are there other structures, like if you don't have that property set up, I've heard this kicked around, is there a trust structure or something that would allow you to take advantage of a 1031 without actually having the property lined up, or is that a myth?
That is something I don't know the answer to offhand. I would definitely have to look at it more. Aaron B, do you happen to know that?
I don't.
Okay, so maybe it's just a myth.
It could be, unless, Pat, you're just trying to avoid paying tax and making up some tax laws here.
Right. Just don't report the gain. You can't imagine that.
By the way, Pat, if you report the gain and you have that capital gain of 500,000 and you need a good wealth management advisor, I think I can refer one to you.
Well, we appreciate that. So I think this formed pretty well with us kicking off this first 15 minutes. We talked about some tax loss harvesting and ways to mitigate some investment gains and whatnot, and also a 1031 and some ideas around real estate. Matt and Aaron on our side, and I know Aaron B and Jake are familiar with it as well. There's sort of a newer rule that takes the 1031 concept, but applies it to what traditionally never had a 1031 avenue, which is public stocks, public ETFs, publicly traded investment vehicles. So Aaron M, Matt L, do one of you guys want to give the attendees a tease as to what a 351, not to be confused with 1031, is and how it works?
Matt, you or me?
You're up.
I'm up. All right. So when we've talked to folks that we work with, CPAs, they're not as familiar with this, but it is pretty exciting. But you run into the same issues as we just talked about with real estate. But that Apple stock you own, money inherited decades ago, you have a portfolio of 10 different things, 12 different things. They've been great, but it's just been too much. You own too much of these 3, 4, 5 different investments, and you want to diversify. You want to sell. Well, this 351 idea allows you, in a sense, to do the same thing as the 1031. Move from your existing portfolio into a diversified one. And your gains all transfer from the first portfolio to the second. So you put your securities in, you close your eyes, you wake up, you're fully diversified, gain has not been realized, you still have that unrealized gain, so it hasn't disappeared. But what Aaron B mentioned is, okay, well, now you have this investment. If it's diversified, you can hold on to it forever. You pass away at some point, and the people who inherit that money get a step up in cost basis, and really no one pays the tax. So it's been, we've gotten a lot of very positive feedback. This is something that we will be chatting about more in the next coming months, but that's the general idea on the 351 topic.
It's really great. And I think that our clients should be better informed about it. It's such a useful tool that people forget about. I think it's great.
Yeah, and then the ETF structure. So what this is, the end investment is an ETF, an exchange traded fund, which most of our clients are very familiar with. Most people that are not our clients are very, very familiar with, but they are extremely tax efficient in their own right. If theoretically, and we're not suggesting this, but if you put every penny you had into an ETF and it was well diversified, if you were to sell, you'd have capital gains. But if you never had to sell, you 99.9% chance you're never going to have a capital gain ever again, because you're not buying individual components and buying and selling. The ETF allows you to make changes under the hood, and those gains do not pass through to the client. So you can effectively wipe out capital gains. Again, not suggesting you put all of your money into one ETF, but just relaying the concept here.
So dumbing it down again for a second too. And Matt, sorry, did you have
Nope, go ahead, Matt. All good.
We keep using Apple and Tesla stocks as our example. We're in a wonderful bull market for those who have participated in the US the last handful of years. Hard to find investments with a loss. But if not for the tax consequences, if I had that Apple stock, hey, I would love to take some profits here, but I don't want to pay the taxes. This is the solution. This is really the kind of never before seen, in some cases, way to diversify your holding, because it makes sense for your investment plan, but not have to pay the taxes. So I think good job kind of by everybody. One thing I want to note on the logistics here, we've got a bunch of attendees in. Thanks again, everybody, for joining us. You'll notice there is a Q&A on all of the attendee screens, or at least it should be. To keep it as interactive as possible, if people have questions, send them in. If they're relevant to what we're talking about at the moment, we'll try and get to it right in real time. If not, we'll grab some at the end. So just want to throw that out there as a reminder. Let's shift gears a little bit. Let's talk about some general stuff that I think people know about, but really some more advanced ways to take advantage of it. Retirement plans. So deferring money into retirement plans. We're all familiar, I would imagine, for the most part. You put money into a 401k, an employer's plan, on a pre-tax basis. That's going to reduce your gross wages and save you some tax. But for those who are self-employed, for people who have side businesses, or let's say they even have that W-2 job, but they're doing something on the side actively. They have a business that's generating contractor work, whatever the case is. Jake, Aaron B, how do you guys think through optimizing a retirement plan setup? A SEP IRA, a solo 401k, a profit sharing, defined benefit plans, which obviously can really allow you
Cash
to
balance,
cash balance.
simple IRA.
Give us
right?
give us the rundown on how you guys think about that stuff and how really to be optimized. And maybe one more thing, and then I'll shut up. What should clients be thinking about before 12/31? Like, hey, do I have to set this up before 12/31? Can I wait until the new year? You guys tell us.
Well, let me take this one because I'm very passionate about retirement plans and it hits home for me. So quick story here. We grew up, our family, very middle class, and we always thought we had no money and our parents were just skating by, and we were like everyone else back then. And my dad calls me up one day, he goes, "Son, I'm retiring." I'm like, "Dad, you cannot live on my couch. What the heck?" And he says, "Well, what do you mean? I have my pension plan." I said, "What are you talking about?" He goes, "Yeah, when I started, back in the day, whether it was it's now JP Morgan, it was Manufacturers Hanover, and through all the series." He goes, "When I first signed my employment paperwork and they brought up the 401k plan, they said, 'How much do you want to put in?' He goes, 'I don't know.' They said, 'Mr. Ansel, you pay yourself before you pay your bills. You're going to max it out each year.'" Taught me a very valuable lesson a couple of years back. So I tell everyone who's working for a company, straight W-2, max out that pension plan every year, right? In 2024, the limit is 23,000. If you're in your 40s and above, you may want to consider doing a traditional, which means deductible. If you're younger than that, the Roth 401k is a phenomenal benefit, right? You pay the tax now, but it grows tax-free. When you take it out, there's no tax hit. If you're over 50, you get a catch-up of another 7,000. So max out that 401k plan every single year, no matter what. For people that are self-employed, there are so many options. Okay, your typical business owner will have himself, herself working and several employees, and may or may not qualify to do one of the other types of pension plans, which would be a defined benefit, which is very robust, a cash balance plan, very robust. But what they could do is always put in a profit sharing plan and put money in for themselves and the employees based on a discretionary amount each year on a formula. Now, if you do not have any employees and you have the cash flow, go all the way, do a defined benefit. There are massive, massive amounts that can be deducted each year. Now, if you're self-employed and you want to do something very straightforward, you could do a SEP, right? You can get up to 66,000 for the year, or 25% of your compensation. That's still wonderful. That's a great amount to be able to put away. Now, if you've done everything, okay, and you're a high income earner, I'm going to give everyone the best advice that I think is out there regarding IRAs. We get this question: can I put in traditional IRA? Can I do a Roth IRA? Most of our clients are, they meet the income limitation where they can't contribute personally. So here's what I tell people. Take 7,000 for yourself. If you're married, your spouse, 7,000, you put it in what's called a non-deductible IRA. What that means is you don't get a tax benefit for it in the year. And immediately after you put it in, you do what's called a backdoor Roth conversion. Now, Pat, Matt, and Aaron M., have you heard of this?
For sure.
Yes.
How many of
familiar
your
with their
clients
work.
listen to you and do the backdoor conversion?
They listen. Sometimes they need a little help executing, but that's okay.
Right. But think about the benefit. All right. Aaron B., I'm making this up, is 30 years old. Every year for going forward until he's 60, he's got 30 years. He's going to do 7 for him, 7 for his wife, 14,000, immediately converting it to Roth, right? 7 and 7, we got the 14, and he's going to do it for 30 years. So at a base amount, that's 420,000. Now, if he, of course, it's going to be adjusted, but with earnings, that account easily can be $1 million, $1.5 million. When he takes that money out, do you guys know, is it taxable or non-taxable?
I know the answer. If it depends if it's in a Roth or not, but
well, we're doing the backdoor Roth conversion, so it would be non-taxable, right?
That's right.
Right.
There you go. It's a wonderful loophole.
So I'm gonna say
always get to them.
Two quick things. If you have the IRA, it does confuse things a little bit because with the pre-tax dollars, now you have commingled dollars, and that's an individual case-by-case conversation. But this also comes to the mega backdoor Roth that not everybody has an opportunity for.
Right.
Let's just say that your employer needs to allow after-tax contributions. And some employers even allow you to do after-tax contribution and click a button, and instantly every single after-tax dollar gets converted to your Roth for you, so you don't have to remember to do it. And it's fabulous. I mean, it is lots of extra dollars, not just 7,000, but it could be 10, 20, 30, 40 additional dollars getting into that Roth, which again, not everybody has, but if your employer does have it, take advantage.
And that's a big benefit, Aaron. I think at a couple of the big tech companies are known for having that, right?
Yeah, absolutely.
I would just add to that, yeah, to your question, Matt, anecdotally, it seems like big employers, a lot of the times where if you have your retirement plan as an employee at a Fidelity, a Vanguard, a Charles Schwab's, Merrill Lynch, these big providers, often 9 out of 10 times, 8 out of 10 times we see, and I know for a lot of the folks I'm looking at on the attendee list, this applies to you. You can do this. You can make after-tax contributions in excess of that $23,000 limit that Jacob mentioned before, up to your 69, which is the total limit for this year. And that is going to give you a supercharged after-tax amount of savings, which can then be optimally moved to a Roth IRA to even further kind of supplant some of those or compound those savings. We're getting some questions on Roth. So I think this is a good topic for us to stick on for a few more minutes. I've got questions around conversion calculators. I've got questions around the backdoor Roth itself. I'll answer just one of these really quick. I'll do, does the backdoor Roth IRA require earned income? So Jake or Aaron B, do you guys want to just touch on that very briefly? What's the one golden rule for contributing to an IRA, any IRA?
You have to have some form of earned income.
You have to have earned income. That's exactly right.
But your limits that we're talking about in order to do a traditional or a Roth IRA take into account your total adjusted gross income. You have to have earned income, but you also need to, have the AGI, the adjusted gross income, be under a certain amount in order to qualify.
Correct.
Okay. Right. However, if you're married and you have a spouse and you do not have earned income and do not qualify for the spousal IRA, you are not allowed to make contributions. And that is why the backdoor Roth strategy would work.
Right, which applies to so many folks that I think we all work with.
Pat, just wanted to chime in with a comment here that as you know, in our business, we don't talk about things in terms of always and never. That's it. So I won't say this is an always case, but I'll say this. I have yet to talk to the retiree, someone who's already retired, that gets there and really regrets having a lot of money in a Roth IRA. Every single one of them, to a person, is thrilled, to Jake's point, that they have this tax-free asset source when they get there. So as we think about retirement planning, retirement savings, and so on, there are all kinds of nuanced answers to everything. But I would say, when in doubt, money you can get on the Roth side of the ledger usually is something that you'll be pretty happy about down the road.
So this answers two additional questions that are in the queue. Answers both of them. Is there a Roth conversion calculator to help decide how much you should convert without going into a new category? Absolutely. We can help with that. Jake and his team can help with that. So work with a professional to help figure that out. And then number two is, Dan, goes to what Matt just said. Should I consider a Roth conversion even if I'm in a high tax bracket? Yeah, look, are you paying at a high level now? Yes. Did it make absolute perfect sense? Maybe yes, maybe no. But to Matt's point, so be it. You paid a little more tax, but down the road, you have tax-free growth forever. Your beneficiaries and heirs are better off because they don't have to pay tax on those distributions when they inherit it. And your required minimum distributions from your IRAs are lower, less taxable income. So
that's right. Now, correct me if I'm wrong here, but if you have a Roth IRA, are you required to take RMDs, required minimum distributions?
You are not required, but if you and this one, it trips some people up. Inherited Roth accounts, you do have to take the required distribution, but it does not count as income. So
all else equal, Roth becomes a great, and so we've got a few topics I know we still want to get to. So I don't want to punt on this because this is clearly a good topic of conversation that attendees want to hear about.
Yeah, and we could do a whole seminar just on IRAs and Roths and Backdoor, and should we convert? I have my own thoughts on that, but I'll table them because I could go on for the next 30 minutes just talking about that.
So I'll just say on the last question that Aaron had mentioned, Aaron M or had just been discussing, even if you're in the highest tax bracket, should I consider a Roth conversion? I would say should you consider? Yes. Do you need to do the work and the analysis? Yes. That's where all of us as professionals can help you. There's all sorts of sets of nuances and circumstances. One topical idea that may kind of shift us to the next topic of other employee benefits. Aaron B, and I were just talking about a couple of these as well yesterday and in the chat today, is let's say you're working for a company and you have the opportunity to take advantage of a deferred compensation program. That has all sorts of nuances, and we'll keep that as a topic that we won't dive into the rabbit hole on, but that would allow you to reduce your income potentially during your working years, hence deferred compensation. You might have lower income. That would be an idea and an opportunity to couple with a Roth conversion potentially, where if you were making $500,000 or $600,000 in income, and you have the opportunity to reduce that in 2025 through a deferred compensation program by 100, 200, again, pros and cons of this, then maybe you can fill up some of that income that you were otherwise deferring, a la a Roth conversion, and really allow those investments to grow for you, faster than you would have if you had waited until retirement. So let's use that. Other employee benefits. Aaron B, do you want to touch on a few of these? Health savings accounts, things that are otherwise just great tax deferral vehicles.
Yeah, I mean, so HSAs are a great additional tax vehicle that you could use. It's got a triple tax advantage. You get that tax deduction before you put it in, and then it goes tax-free and it comes out tax-free. So it's got a real nice triple advantage there. And what's nice about it is, think about it this way. Let's say your health insurance for a typical low deductible plan might be, I don't know, let's just throw out a number, $15,000 a year. But that high deductible plan might cost you, I don't know, in the range of $7,000 a year. So that difference can be contributed. Let's say the max contribution to a high deductible to a HSA would be like $8,300 for a family this year. So you're basically, instead of putting it into the health insurance premiums, you're basically putting that money away for yourself for the future. And if you don't end up having any health issues, then you basically have that money for yourself for the future. A lot of people, what I advise people to do is do that HSA. Try not to tap into it for your health expenses, even if you have them. But it's always good to have as an option, or if you can put that money up front on the other side. So that's something that I love to talk about as well.
I couldn't agree more. And I'll add a couple of things that I think really make the HSA tantalizing is, number one, to your point, if you're able to let it grow for you, we're all aware in our country, people are living longer. We have healthcare costs that are exorbitant. Long-term care is an enormous topic of conversation. It's expensive to cover. Well, if you can mentally handle your out-of-pocket costs during your working years because you have income within reason, and defer as much and do this, just like Jake was using the compound interest example in an IRA, do an HSA every year, $8,000 plus every single year for 30 some odd years, and you let that money grow, you're going to have a fairly significant large chunk of change that you could use tax-free for healthcare in retirement. And that may cover a lot of these potential long-term care issues. So that's one. The other one I was going to say too, which I actually learned about this year, and Jake and Aaron B, I'm curious for your thoughts here and how it works in reality, but you can use apparently old healthcare receipts to take money out of HSAs. So let's use an example. Let's say I'm age 60 this year, and I have a bunch of healthcare costs that I pay for out of pocket. And then 10 years from now, I'm age 70 and I have a balance in my HSA, and I'd love to take that money out to use for anything and not have to pay the taxes on it. I can submit old healthcare receipts and make claims for costs that I've had previously and use those to take money out of my HSA and then not have to pay the tax. Aaron B, Jake, do you guys want to talk about your experience with that?
Absolutely.
Yeah.
That there's 5 things you can do with unused HSA money. The number one on the list is exactly what you said. You can reimburse yourself at any point, at any time for past expenses. Okay. Second thing, you use it for future healthcare costs, just like you said. But here's something that most people really don't know about is once you reach age 65, you can withdraw the HSA funds for any purpose, not just medical, and you don't pay a penalty.
Right.
But if you pull the money out for non-medical, it's like taking a required minimum distribution and you pay ordinary income tax.
Right.
But if you're at age 65 and above and your income tax is lowered because you're not working and you're, living off retirement funds, it may be okay to do that. Okay. And you're allowed to keep contributing to an HSA as long as you have a high deductible health plan and watch your balance grow. And what many people forget to do is exactly what you said, Pat. They forget to invest those funds.
Yep.
I don't know if you're aware, and I see this so often where they're sitting in a checking account. Okay.
Yeah.
So those are the top 5 things, but the most important thing is what you said. Keep your receipts. You can reimburse yourself at any time. If you don't need the money, build it up.
Totally agreed. So I'm going to
add
shift
to that.
Oh, go ahead.
Yeah.
Sorry, Aaron. Go ahead.
Yeah, one more thing I wanted to say. A nice benefit of the HSA is like, you might have Medicare when you're retired. You can use the HSA to pay for your premiums as well. So that's also a nice additional benefit of having that HSA. You don't have to think about that, and you could use that money tax-free.
So no shortage of reasons to love an HSA and Roth money. Everyone on this panel loves HSAs and we love Roth. So come see us for all the ways to maximize those strategies. I'm going to
saving money, Pat.
That's right.
Who doesn't love money?
That's right. So let's shift to a couple other money saving things that you can do before year end and tax saving items. So just shifting away from some of the Roth and investment related stuff, let's talk a little bit about deductions. Obviously for businesses, it's one thing, but let's just talk on a personal basis on someone's 1040. Aaron, Jake, do you guys want to give us just a quick blanket? What's the difference between a standard deduction and an itemized deduction? Just to set the tone for some of the strategies that we may be able to delve into here on deductions.
So Aaron B, I'm going to let you take it because I'm long-winded and I'll go on just about donor advised funds as an example for 20
That's all right. We'll come back to you on that one then, Jake.
Yeah.
Go ahead.
Yep. No problem. So standard deduction, the IRS sets a standard deduction that you would get off of your income, basically like a standard exemption. So I think in 2024, it's $29,200. Now, if you have expenses, and there's a list of qualified expenses that belong in an itemized deduction list, and if those itemized deductions exceed what is the standard deduction, you can elect to use the itemized deductions. So let's say your itemized deductions add up to $40,000. You take a $40,000 deduction towards your income. If your itemized deductions is $20,000, then you take the standard deduction and you get that $29,000 deduction. So that's just a nice quick comparison of the two.
Well done. And on the itemized side, because I often get this from clients, is like, oh, I have mortgage interest, so I have a deduction still, because now with the new Tax Cuts and Jobs Act from 2017, things have changed. The standard deduction, to your point, Aaron, is higher. And I'm like, well, that doesn't always mean that it actually translates to tax savings for you, unless you have itemized deductions that are above the standard deduction. So the big ones are, right, mortgage interest to a certain amount.
Up to a limit of, correct.
Right. State and local taxes, which are capped at 10. We will come back to the SALT stuff. You got charitable deductions. You have medical expenses above 7.5%. But let's focus on those firstly. And really, if you think about that, right, Jake, Aaron, everybody on this call, we only have so much control over those, right? If you're paying a mortgage, you only have so much control over how much you're paying. If you're living in a state that has, property taxes and deductible state taxes, there's only a cap that you can do there. So really what I find, the biggest way that you have ability to have flexibility in your deductions here is the charitable piece.
Right.
So do we want to dive into charitable stuff? And Jake, do you want to go in a little bit on donor advised funds and some of that fun stuff?
Sure. I'll take that. So in general, charitable deductions are limited to 60% of your income. Okay. And there are other limits based on the type of assets that you're donating. But in a normal year, if you are of the charitable mind and want to give, your limit is at 60%. So you want to make sure that you don't give anything above that. segueing into a donor advised fund, if a client has a large activity that went on during the year or a sale of an asset, okay, you want to use a donor advised fund. You could set up a family foundation as a non-for-profit, but basically the gist of them is as follows. So this past week, we had a client sell their business for $66 million. And we're looking at all different ways for him to save money. Turns out it's a capital gain, some part of it ordinary income. And I said to the client, are you inclined to give charity? He goes, oh, I love to give charity. I said, if you had to think about an amount today that you would give for the rest of your life, what would that be? He says, oh, I got that, $3 million. I said, great. So this is the perfect year. He had a liquidation event, sold his company, 66 million. I gave him the two choices. You put it into a donor advised fund, you drop the 3 million in, and they handle the investments, they handle the distributions out to other charities, or you could do it for yourself. And doing it for yourself means we'll set up a family foundation and it will have some legacy to it, right? Hopefully it will continue to grow. We'll manage it with you, and you have to give out 5% per year of the assets. And he chose to go with the latter. He wanted to leave a legacy, not it for, he didn't want it to sit in, a general donor advised type of fund that some of the larger brokers' houses will offer to you. But the benefit here is he got that immediate deduction for the 3 million, but he doesn't know who he wants to give it to. And who he wants to give it to today may change tomorrow. Right? So it's a massive planning tool when you have a significant event happen. But there are also clients who have consistent, strong income. Take a client that makes on average between 500 to 2 million a year, and they like to give charity. Okay, but they're just not sure who to give it to today. Right? Their kids may go to Colgate University and they may fall in love with Colgate and say, all right, I want to give it to them. So they'll also set up, a donor advised fund and give it out in that respect. A very powerful tool, very overlooked. And I'm glad that you guys are paying attention to that and telling clients about it.
Yeah, I mean, I couldn't agree more. It's an incredible tool. Matt L, Aaron M on our side. Maybe you guys could touch on a little bit about how the your investment plan can tie into a donor advised fund. So let's say, again, using this example, we keep going back to, I have investments that have highly appreciated and they have gains that I would otherwise pay tax on if I sold. How can you, foray that into your donor advised fund?
Go ahead, Matt.
Yeah, so I think it really comes down to tax efficiency. And then also I wanted to just make one point on operational convenience, which I think is a hidden benefit to donor advised funds. But yeah, so let's use your example. You're sitting there, long-term unrealized gain on Apple. You happen to be charitably inclined, not sure where you want to give it yet or whatever. But you're not, you're not opposed to diversifying out of your Apple as well. You can take those Apple shares and put them into your donor advised fund or I guess other charitable vehicle if you had gone, a different route. And where that benefits you is you get the deduction like Jake described. I mean, as long as you adhere to certain standards on it. And you essentially get out of the apple, as it were, without having to recognize the capital gain. So you're winning on both sides there. And then just the last piece I wanted to mention on donor advised funds, because I found this myself, now using one much more frequently, is all of us that are charitably inclined may have some core organizations that you like to give to, but you may also have friends, family members, coworkers that have their core organizations, and they may reach out to you over the course of the year. Like, hey, I'm doing this walk, I'm doing this run, this matters to me, there's an event, whatever. And I found before I had a donor advised fund, it was just very inefficient. I would, go online and make a donation here, a donation there. End of the year came, going over my information with my accountants. And I'm like, either faced with not getting the deduction because I have no recollection and no records, or going through and spending the tedious amount of time going through all those records. Simplifying your life, because part of what we are supposed to do for people is make their lives easier by having that donor advised fund. And usually with most organizations that your friends, family members, coworkers want you to donate to, it's just a point and a click, and then you're done. The money goes. You don't have to keep any records because it's already in the donor advised fund. And I just find it to be a much easier way to deal with charitable life.
Matt, I agree with you, but there's also one hidden benefit. So Aaron calls me up the other day, Aaron M, right, from your office, and he says, Jake, I'm taking in these contributions and I'm asking you nicely to send a donation to my ping pong fund. My ping pong fund. And I'm like, Aaron, you know what? You have to go through my donor advised fund. We have a board. Submit what you wanted to do. And guess what? They came back and they're like, Aaron M, we really appreciate the suggestion. However, at the current time, we are not donating to your ping pong fund. Little
Nice
hidden
way to-
benefit there too. We all get hit
Arm's
up.
length.
But in all reality, it's very powerful, and what you're saying is great for record keeping. It's never challenged at the IRS,
Right.
whether it was a 501 at a qualified deduction. So great point.
And one in the charitable vein, we could talk, I'm sure, about donor advised funds and private foundations in a little more detail, but for the sake of time, we've got a couple of questions. One I'll bring up now around RMDs, IRAs, 401ks, and utilizing, well, I'll say strategies to alleviate required minimum distributions and taxes due on those. Marrying this charitable concept, does anybody want to touch on QCDs and how those could foray? Anybody?
Yeah, you're charitably inclined. You are beyond required minimum distribution age. I think that's
Or age 70 and a half, just to clarify for you, Aaron.
Correct,
Before we
correct.
get to RMD age.
Okay, so let's just say you're going to take your normal required minimum distribution and it's $1 or whatever it is. That dollar, it comes to you, it counts as ordinary income. You've got to pick that up yourself. However, you can actually skip over you taking it and go directly to charity. So that's that QCD, qualified charitable deduction, distribution, whatever it is. So yes, from IRA directly to charity does not get picked up as income for yourself. And you're able to donate that way as well.
And Aaron, question for you on that. So instead of taking my required minimum distribution, right, because I'm that age right now, and I send it over to a charity, do I also get a tax deduction for that?
I do not believe you do.
Does anyone know that answer?
I don't believe so. You could raise it. Should just be, rather than having, and the QCD limit is $100,000, right, Jake?
There we go. That's it.
Correct.
That was my next point. It's 100,000 per spouse. So each one can do 100,000. I have a lot of clients that do this. They're very charitable and they don't want to pay the tax on their required minimum distribution.
Yeah, I'm happy I got that answer right. So I'll tell you, for people that do this, you should be careful. You know, some people want to take their whole RMD early in the year. They do it, and then December comes around and they want to give to charity. Well, you've already taken the whole RMD, and
Right.
yeah,
Yep,
you just
good point.
make sure you're paying attention to it
Agreed.
throughout the year.
Yeah,
So-
absolutely.
So I just got excited on my end for the question that just came through as a stock option and stock award nerd, self-proclaimed. Aaron B and I had an awesome client conversation yesterday. We were talking about all kinds we were going down a rabbit hole, Aaron and I, yesterday, about ways to look out for AMT and all that kind of stuff. So question that just came through, we'll answer it live, but I was going to bring this up as a topic anyway. Around the year end, what's AMT? How should I think about it for my stock options? So maybe I'll start by just saying, around this time of the year, great checklist item for your accountants, for your wealth advisors. Talk about your stock awards. Make sure you have a strategy in place. Look at your overall exposure. Look at how exercising or selling things is going to affect your tax picture, and if that's going to put you into different types of brackets and all kinds of things. So why don't we start? Anybody I get in this call, I'm sure, can handle. Let's talk about stock options for a second, and let's talk about just the quick differences: incentive stock options, non-qualified stock options. Two different sets of tax rules. I guess just as easy to digest as possible. We just go through how those work.
I'm happy to hit it quickly. Non-qualified stock option, it counts as income. I don't care what you do. You buy them, you sell them, you cash them out, you do this, that, income, at whatever income bracket you're in. Incentive stock options, or ISOs as they're called. There are several ways that you can purchase those options, whether it be with cash or other company stock. And it is a non-taxable event at that event of buying the option. Now, there is alternative minimum tax exposure, which we'll get to, or potential exposure. And then you own that stock. You've exercised your option. You own the stock, and you wait a year plus. You sell that stock now, and you get long-term capital gains treatment rather than ordinary income.
So what's the big deal if I want to exercise, if I want an ISO this year, right? Why is that an issue with the AMT? And I'm asking for the benefit of the audience. And I know, Pat, you went through this with Aaron B yesterday.
So I'll tee Aaron B up here based on the questions, right? So let's say I've got X amount of ordinary income, and maybe Aaron B, you can touch just on AMT in general. Like, what is it? What triggers it? For a lot of people, it's obviously the incentive stock option piece. Can I just blindly, exercise as many stock options as possible? What's getting captured for AMT purposes? Take it away, Aaron B. What can we do there?
Yeah, thank you. So just a quick overview on AMT first. AMT is an alternative minimum tax that basically captures, like, if your income tax is too low for purposes of how they calculate, AMT has some adjustments that they require you to do, which they calculate a tax on that. And that tax rate is like either 25%, 28%, depending on your total income. Now, for the AMT calculation purposes, we take taxable income, which is your typical calculation for taxable income, and we adjust let's use incentive stock options, for example, right? You were awarded incentive stock options, and the strike price is $80, and the current fair market value of that stock is $100. Now, that difference, if you exercise it in that year, that difference is now an adjustment for AMT, and now you have a higher AMT taxable income versus your typical taxable income. So what you end up doing in that case is you end up having to pay the difference in tax that we calculated for AMT. And so we want to try to mitigate that, right? We want to try to reduce that exposure by planning with different things that, different options that we may have to reduce that AMT exposure.
Right. Like, Aaron, what you just said is exactly right. And the planning that can be done to mitigate some of the AMT risk is spreading out your exercises, right? Do a portion each year that will allow you to stay under the AMT, alternative minimum tax thresholds. One thing that I've learned, and maybe you guys can comment on this, is exercise it early in the year. And by doing that, it allows time for the stock to appreciate further before the next year, before the next tax year. But if the stock price falls, you can sell it before the end of the year to limit that AMT exposure. So those are two things that I've learned. I'd love to hear from the Amplius group what they think about that.
I think it's a great idea, number one. And I'm just to keep piggybacking more and more on this. Certain people, and I see in the list of people who are in the Zoom here, certain employers, I guess maybe most even do this. When you have incentive stock options and you retire, those incentive stock options, you get to keep those, their regular expiration schedule. But within a month or two of post-retirement, they change automatically from incentive stock options to non-qualified stock options. So Jake just said you want to spread out the purchases. You don't do it all at once. So yeah, work with your financial advisor, not a day before retirement, but years before, and start buying those options. Keep yourself under the AMT limit so that you can take advantage as much as possible and not scramble at the last minute, buy as many as you can. And then you either go into AMT or you keep it under, but now you have a whole lot of options that are now non-qualified and will ultimately be counting as income.
Yeah, it's one of those things. I mean, there's so many reasons to do it. It's self-serving for all of us, but really, I'm sure all five of us have had that experience or that conversation where someone comes to us and says, yeah, look, I'm not ready to start planning for retirement. I'm still a few years out. I'm still a year out, which is always hilarious to me. It's like, well, how much money in a year? But it begs the point. This is one of a million reasons as to why, as early as possible, plan for these things. Because if you've got an enormous amount of incentive stock options or any number of reasons why you need to be planning over multiple years to minimize your tax burden, set yourself up optimally for retirement, take advantage of capital gains tax rates. You can't just do it all in 1 year. You really can't. It's impossible. You're going to get left with a probably suboptimal tax bill by consulting too late. So more just, again, kind of a self-promotion, but consult with people early on and have this plan and really get a strategy in place the earlier the better. So good. I think well articulated by everybody here.
So there's a question up in the Q&A. If I could just take this one, because I'm getting this all
Yes.
the time here. And the question is there a realistic possibility that unrealized capital gains could be taxed with the new Congress? So let's take a step back here. Before any new tax law actually goes into law, you have to have a proposal that begins in the House of Representatives. It goes to the committee. It goes back to the House, then to Senate action and the Finance Committee. Okay. And then the final bill is sent to the president, who can either sign it or veto it. Think about all those steps. That's a long list of ways to get to a final tax law being passed. Now, let's think about the impact. Unrealized capital gains. We keep going back to Apple stock, right? We bought it in the 80s. I have $1 million of unrealized. I've never sold it, of capital gains. Think about what that will do to the economy. Almost every client that we come across has unrealized gains. They don't have the cash in hand. It's sitting in their brokerage account. If something like that is a proposal, how could it possibly make it into law? And if you think about it, most of the people that this process is going to go through to get it to law, right? The conference committee, the Senate Finance Committee. Do you think that the people who are sitting in those chairs, I'm sure undeniably they have massive amount of capital, unrealized capital gains that would destroy our economy. It would make people nervous about spending money. But a law like that would be next to impossible to get through, in my opinion.
Right. Or
now,
to
we've
track.
seen, or to track. Very good. Like, how is the reporting done? Does that mean Amplius now needs to submit at the year end all of the unrealized capital gains to the government? I mean, that's just insane. So
Sounds like a nightmare.
it's a proposal. I pay no attention to it. So I hope that came from Nathan G. I hope that answered your question.
Yep. Yep.
Guys, I know we only have 3 more minutes here, and we probably did not get through, some of the items. Could I just talk for 1 minute about Social Security?
Please.
Okay, I don't know the age of anyone, that's joining us today, but I will say it's not a simple answer about when you should start taking Social Security. And I've done analysis and I built charts and tables on, for many clients, whether they should take it when they're eligible. Do they wait to age 66? Do they wait to age 70? And the conclusion that I really came up with is obviously it depends on your income, right? If you're still working, you don't want to repay Social Security, so you're going to wait. But if you're retired, the conclusion that I've come to, right, wrong, or indifferent, and I want to hear what the Amplius team has to say, is, but if you start taking it, for example, at age 66, and let's just say you're going to live until age 75, most of my clients will get, on average, about 200,000 more by starting at 66 versus starting at age 70 by the time they hit 75. So they start at 66, they wait to age 75, see how much money is built up versus starting later. And the key here is if you don't need the money and you took the monthly distributions that came into your account and you invested it wisely with Amplius, sorry, if you invested it wisely there and you're getting, 8-10% return on your money, you're going to do much better by starting early if you're able to after you retire. That's been my conclusion, and it's hundreds of thousands of dollars difference. And some people say, listen, I'm going to live to the age, 120. Should I delay it? How do you know, right? But some people have a long line to, that they've come across with their family, and they know that their people live until age 100 or whatever. So it's not an easy answer.
I'll tell you the one human element that comes into it. You mentioned taking it, and if you don't need it, save and invest it. A lot of people agree, yeah, I'm going to take it early. I'm going to put it into my investment account and we're going to grow it. And the human element comes in and they spend it. So the tricky part is, you got to follow through.
Yeah.
And even if you don't, if you pass away at some age, it still might make sense to take it early. Right. But yeah, if you
I
really
definitely agree.
or save and invest.
The only thing I'd
Right.
add here, and I know we're coming up basically on time, I would just want to say, I want to agree with both of you guys. The way I often look at Social Security is, yes, it is such an individualized picture. You need to know all the different components, which is why you have to have a good retirement plan in place and the right people to talk to. I'll just say two things. Tactically, let's say you retire at 60 or in your early 60s. You have often, I'm sure Jake and Aaron B would agree, you have some golden tax planning years right after you retire. What I mean by that is, if you have a low income, lean income, maybe don't add to your income by taking Social Security, because you could do things like taking advantage of a 0% capital gains rate, or do a Roth conversion, or do all these things that we're talking about with some really lean and smart tax planning. The other thing I'd say just on Social Security is what often gets or not talked about is the qualitative, again, more human side. Is people know often, hey, if I live into my 90s and I wait and I take it to 70, cumulatively, I may have more income to my name on a cumulative basis. Like Jake said, there's models to do that. But what I always consider is, what are you using the money for? Like, if you can use and enjoy that money at age 66, age 67, because you can go travel and be mobile and see your kids and see your grandkids, is that more powerful than waiting until you hit a break-even number at 92 where you can't go see your kids and you're not mobile and you're in a retirement home? I don't know.
Good
You tell me.
advice.
There's a qualitative element there of, why are we all saving money and having income in the first place? It's hopefully to enjoy our lives and enjoy ourselves and live a good retirement. So that's a piece that often gets missed. I know we're up on time. What might be great as we kind of wrap here, funnel it to a Roth. Sorry, I'm getting distracted by this question. You can't, on the Roth thing, you can't funnel Social Security to a Roth because you need earned income to contribute to an IRA, which is going back to what we were talking about before. Social Security does not count as earned income. So we're gonna send out this recording. We're gonna send out the recording of this entire thing. We still got some attendees in here. Maybe we'll do a survey, guys, with the attendees, just to say, what topics did you like? What would you love to hear us talk about next? How should we follow up? Get some feedback from everyone, because I think this was really successful. I think we hit on a lot of good stuff here.
Excellent. I
Sounds
agree.
good.
Thank you, everyone.
Yeah, I agree. Thanks everybody for tuning in. Ask us any follow-up questions you have. You need any introductions to Jake and his team for follow-up questions as well. We'll put you in touch. But again, thank you.
Thank you so much.
Buddy.
And
All right,
Pat,
guys.
good job moderating.
Oh, thanks. Thanks to you guys.
Excellent.
It's very easy when you got a bunch of all-stars on the cast.
All
All right, everybody, have a great day. Happy holidays.
You
And
too.
talk soon.
Thank you.
Bye.
Thank you.
Bye-bye.